Welcome to the Deep Dive. Today we're tackling a financial number that, honestly, almost looks like a typo.
It really does make you blink, doesn't it?
We're diving into the Q2 results for Vikram Solar, a major Indian solar manufacturer. And yeah, we're talking about profit after tax growth of, wait for it, 1,636.5% year over year.
Yeah, that's the figure that jumped out. I mean, a 16-fold increase in profit in just a year? That doesn't just happen.
No way.
So we've dug through the investor decks, the official filings, the press release, basically trying to get the full picture behind this financial skyscraper, as you might call it.
Exactly. So our mission today is pretty straightforward.
Yeah.
Figure out what actually drove this massive growth, understand their, frankly, dizzying expansion plans, and importantly, see how government policy and industry trends in India are, well, maybe creating the perfect conditions for it.
Right. We want to give you the essential context.
You get the complete picture. Let's jump in.
Okay, let's start with the money, because the Q2 FY26 numbers compared to last year Q2 FY25 are just huge across the board.
So, total consolidated revenue.
Hit INR 11,110 crore. That's up nearly 94% year on year.
94% revenue growth is, that's fantastic on its own. But that absolutely wild profit after tax number suggests something else is going on, right?
Yeah.
Something deeper than just selling more stuff.
Exactly. It points towards efficiency. You really have to look at the profitability metrics.
Okay.
EBITDA, for instance, it soared to INR 235 crore. That's a 225.9% increase.
Wow.
Now, the company line is improved operating leverage and enhanced internal efficiencies. You know, standard corporate language sometimes.
Right, you hear that a lot.
But here, the numbers genuinely back it up dramatically.
So they weren't just shipping more panels, they actually got fundamentally better at the whole process. Manufacturing, logistics, everything.
Pretty much. Look at the EBITDA margin. It jumped from 12.59% in Q2 last year all the way up to 21.17% in this quarter, Q2 FY26.
That's a massive jump, over 8.5 percentage points.
It is. And that operating leverage thing, for a solar manufacturer, think about it. They have these huge fixed costs, right? Building and running these massive
That's the caps is enormous.
Exactly. But now those costs are spread across nearly double the volume of modules being sold. So each extra module they sell becomes way more profitable.
Okay. So the cost per unit drops significantly as volume ramps up.
Precisely. And it's that combination, more volume plus much better efficiency, that delivered that headline 1,636% PPAT growth.
Which pushed the PET margin itself from, what, just 1.29%?
Yeah, barely profitable on that metric last year to a really quite healthy 11.58% now.
And just to be clear, this wasn't some one-off fluke in Q2.
Doesn't look like it. The half-year numbers, H1 FY26 compared to H1 FY25, show similar momentum. Revenue up 86.4% for the first half.
Okay.
And PAT up 767.2%. So sustained high growth over 6 months.
Right. But, high-flying stories often have some, let's call them nuances in the financial reports.
Yes, asterisks are common. And to give you that complete nuanced view, we do need to talk about a couple of significant legal contingencies. These kind of put a question mark next to some of that reported profit.
Okay, this sounds important, especially regarding money they're counting on but don't actually have in hand yet.
Exactly. The first one involves a trade policy thing, the safeguard duty dispute.
Right.
The company has paid out a lot of money here, INR 1,485.24 rupees.
Okay, paid out.
Paid out, yes. But, and this is the key part, in their financial statements, they've booked this amount as a receivable.
Meaning they expect to get it back. They're counting it as an asset.
Correct. They're essentially betting on winning the legal case. The whole thing is currently sub judice. It's tied up in the Supreme Court and the Orissa High Court. Management says they have strong legal opinions suggesting they'll get the money back.
But it's not guaranteed. It's a legal risk baked into their assets.
It's money currently tied up in the system, absolutely. A potential risk to that receivable number.
Okay, what's the second contingency? You mentioned disputes with customers.
Yes, this one involves their trade receivables money owed by customers. There's another INR 843.88 million included there.
Okay.
That customers have actually withheld or tried to recover from Vikram Solar.
Why? What are the customers claiming?
Usually things like liquidated damages, maybe claims of generation loss from the modules, things like that. Standard contractual disputes sometimes.
And Vikram Solar disagrees.
They're not accepting these claims, no. They've taken the disputes to arbitration or court. Again, management expresses confidence they'll win.
But again, it's disputed money. So between those two items, we're looking at what, roughly 233 crore rupees that are booked as assets but are currently contested.
That's about right. Nearly 2.3 billion rupees. It's crucial context for understanding the, let's say, quality of their reported receivables and assets.
Definitely essential context for anyone looking closely at the balance sheet. Okay, let's move from the financials with those important caveats to the operations. Because ultimately, the financial success, even with these disputes, is built on actually making and selling a huge volume of solar modules.
Absolutely. And the operational numbers really paint that picture of scale. Module sales volume in Q2 FY26 was 784 megawatts.
Okay, 784 megawatts. How does that compare?
Compare that to just 271 milliW in Q2 last year.
Wow.
That's a 189% increase in volume. Just massive. That's what's driving that near doubling of revenue we talked about.
And they managed to produce that much efficiently.
It seems so. They reported 84% effective capacity utilization in the quarter, which is pretty good.
And this momentum looks set to continue, right? Because the demand they have lined up is, well, it's huge.
This is where it gets really interesting, yes. The forward-looking picture, their order book.
What's the number?
As of September 30th, 2025, their confirmed order book stood at 11.15 gigawatts, GW.
11.15 gigawatts.
Gigawatts. And here's the crucial part. That's more than double their existing rated manufacturing capacity.
Okay, so they have confirmed orders for twice as much as they can currently make.
Exactly. Which provides this incredible runway of confirmed future revenue. It significantly de-risks the massive expansion plans they're undertaking.
Right, because they know the demand is already there, waiting for the capacity. And who is placing these orders? Is it mostly big government projects?
Actually, it's overwhelmingly domestic. 85% of that 11.15 GW is for the Indian market, only 15% exports.
Okay, 85% domestic. And within India?
Within India, it's pretty well diversified, which is a good sign. The biggest chunk, 52%, comes from independent power producers, the IPPs. These are the large solar farm developers.
Standard players.
Right, but what's really encouraging is the strength in the C&I segment, commercial and industrial projects. That accounts for 20% of the domestic orders.
Why is C&I particularly important? Why highlight that?
Well, IPP projects are often huge, sometimes reliant on government tenders or policy support, which, can fluctuate or face delays.
Sure, political risk, timing risk.
Exactly. The C&I sector thinks solar panels on factory roofs, corporate campuses, warehouses. That's generally seen as a stronger indicator of broad, sustained private sector adoption. It's less dependent on single large tenders and more on distributed business decisions.
Makes sense. And actual direct government projects.
Only account for about 8% of the domestic order book. So it's mostly private sector-driven demand split between large developers and smaller business installations.
Okay, so that massive 11.15 GW pipeline explains why they need to expand, which brings us to their strategic leap, this incredibly aggressive capacity expansion.
Aggressive barely covers it. It's huge. It's dual-pronged. Modules and cells.
Let's start with modules. What's the target?
They're aiming to scale up from their current 4.5 GW capacity,
Which is already significant.
to a planned 17.5 GW by the end of fiscal year 27.
17.5 gigawatts. In roughly 2 years, that's almost quadrupling their size.
It's a phenomenal pace of expansion, jaw-dropping, really.
That just sounds incredibly difficult. I mean, aren't there huge execution risks? Finding the land, getting permits, financing it all, sourcing the advanced manufacturing equipment globally. That seems like a major challenge.
Oh, the execution risk is immense, no doubt.
Yeah.
But the sources suggest they've thought about mitigating some key factors.
Like financing. How do you fund quadrupling your capacity?
Well, partly through their recent IPO. They listed on the BSE and NSE back in August 2025, remember?
Right, the IPO.
A specific use of those IPO proceeds is earmarked to partially fund the capital expenditure for Phase 1 and Phase 2 of this expansion, happening via their subsidiary, VSL Green Power Private Limited.
Okay, so some funding is secured. What else gives them confidence?
I think it comes back to that huge confirmed order book we just discussed. They see overwhelming domestic demand locked in. And crucially, they're not just building more capacity, they're building advanced capacity. They're pivoting their technology.
The technology shift. They're going all in on N-type modules, right?
Yeah.
Not just scaling up the older tech.
Yeah, exactly. This is absolutely critical to their long-term strategy. They're moving entirely away from the older P-type tech, which includes things like PERC modules that were common,
Okay.
and focusing 100% on N-type technology. Think top P-Con, maybe HJT, These N-type cells offer higher efficiencies right out of the gate, and importantly, they degrade much slower over the lifespan of the panel.
So a better, more valuable product long-term makes them more competitive.
Precisely. It makes their product premium, helps compete globally, and aligns with where the industry is heading. They're investing for the future, not just catching up. And they mention using robotic process automation extensively to ensure quality and speed during this massive scale-up.
Okay, so 17.5 gigagrue of advanced N-type module capacity by FY27.
Boy.
What's the other prong of the expansion you mentioned?
Backward integration. This is perhaps the most significant strategic move they're making.
Moving down the supply chain.
Yes. They're entering solar cell manufacturing in a big way. They're targeting a massive 12 gigawatt of cell capacity by FY27.
12 gigawatts of cells.
Yes. They're billing it as potentially the largest cell gigafactory in a single location.
Why is making their own cells so important? Isn't it easier to just buy them on the global market?
It can be, but it exposes you to price volatility and supply chain risks, especially with geopolitical tensions, by making their own cells domestically.
Control.
Exactly. It gives them much greater control over their costs, insulates them from global shocks, and provides supply certainty. It's about de-risking their massive module operation.
Okay, this all makes sense strategically, but this kind of colossal expansion, it feels like it wouldn't be feasible without strong support from the wider environment, right?
Absolutely not. You need strong tailwinds, and the sources frame this perfectly. They talk about the Indian solar growth story being at an inflection point.
An inflection point driven by?
Driven or perhaps engineered by government policy. The Indian government is actively creating a protected, supportive environment for domestic solar manufacturers like Vikram Solar. It massively reduces their external risks.
How are they doing that? What are the specific policies?
There are a few key ones highlighted. First, trade protection. India's Directorate General of Trade Remedies, the DGTR, has recommended anti-dumping duties on imported solar cells and also encapsulants. These duties target imports from several key countries: China, Malaysia, South Korea, Vietnam, Thailand.
So making imports more expensive.
Essentially building a defensive wall. It makes imports less attractive, giving domestic players like Vikram Solar a cost advantage in their home market.
Okay, that's the defensive part. What about proactively encouraging domestic production?
That comes from the Make in India initiative, getting more specific. The Ministry of New and Renewable Energy, MNRE, has its ALMM list, the approved list of models and manufacturers.
Right, you need to be on that list to sell into many projects.
Exactly. And the new version, ALMM3, now mandates that starting from June 2028, even the upstream components, wafers, and ingots must be from listed domestic manufacturers for projects requiring ALMM compliance.
So that forces the entire value chain to move onshore.
Pretty much. It creates guaranteed future demand for domestically produced cells, wafers, ingots, justifying Vikram Solar's huge 12 GW cell factory investment. They're building capacity to meet mandatory future domestic demand.
Makes sense. And on top of protection and mandates, anything boosting overall demand.
Simple economics, taxes. The GST Council cut the goods and services tax rate on renewable energy equipment modules, rooftop systems, etc., down to just 5%.
Making solar cheaper for everyone.
Exactly. Lowering the cost for the end consumer helps accelerate adoption across the board, from huge solar farms to rooftop installations. It helps ensure there's enough demand to actually absorb all this new capacity coming online.
Okay, before we wrap up, just a quick note on governance. With this kind of massive expansion, you'd hope they're strengthening their leadership too.
Seems they are. The report mentions recent board appointments effective December 1st, 2025.
Who did they bring in?
Significant experience. Mr. J.P. Dua, he's a former chairman and managing director of Allahabad Bank, so deep financial sector expertise. And Mr. S.G. Menon, a former senior vice president at Tata Consultancy Services, TCS, so strong operational and tech background.
Bringing in that kind of seasoned leadership definitely suggests they're serious about managing the complexity of becoming a 17.5 GW giant.
Right. Preparing for the next level of regulatory scrutiny and financial management that comes with that scale.
Okay, let's try and bring this all together. So for you, the listener, what's the main takeaway here? Vikram Solar delivered truly extraordinary Q2 financial growth. That staggering 1,636% PK jump, 94% revenue growth.
Driven by a potent mix of just selling a lot more, yes, but also getting significantly more efficient operationally.
And that growth is underpinned by a massive, confirmed 11.1 DW order book, giving them huge revenue visibility.
All while they're executing this incredibly ambitious strategic pivot pouring investment into advanced N-type module technology, and crucially, backward integrating into cell manufacturing on a massive scale.
And this whole strategy seems perfectly timed to ride a wave of supportive government policies, specifically designed to boost domestic solar manufacturing in India. Though it's important to remember those financial contingencies, the disputed receivables, as a point of caution.
Definitely. So the scale of this ambition is really something. And it leads to a bigger thought. We've seen the strong government push. We've seen Vikram Solar's commitment to hit 17.5 GW of modules and 12 GW of cells by FY27. This level of rapid capacity building in India is almost unprecedented.
Right.
So the provocative question for you to think about is this. Once all this Indian capacity, from Vikram and others likely following suit, comes fully online after 2027, how will this fundamentally change the global solar market?
Hmm.
Will India, fueled by giants like this, shift from just being a massive buyer of solar technology and equipment to becoming a fundamental price-setting force in the worldwide solar industry? What does that mean for global equipment prices and technology trends beyond 2027?
That is a potential tectonic shift to ponder. We'll leave you with that thought. Catch you on the next deep dive.